For a while now, one of the most heavily requested stocks down in the comments section for me to do a review video on has been SoFi Technologies, ticker symbol SOFI, who is a fintech company very similar to other popular fintechs like Square or Robinhood. And with SoFi, they IPO'd fairly recently in 2020. The stock skyrocketed and then it proceeded to crash, getting absolutely destroyed, falling by over 65% from its highs all the way down to where they trade today. So in today's video, I'm going to do that review for you guys. I'm going to talk to you about their business, what they do, what their future looks like, why the stock crashed, and of course, as always, I'll let you know if I plan to buy this stock myself anytime soon. Should be a fun one. Let me know down below what other stocks you guys want me to do review videos on. But with that said, let's get started. What's up everyone, my name is Ale. Welcome back to my world of stocks. Alright, let's go ahead and start by doing a quick intro into what SoFi is and what they do. Then we'll pull up the stock chart, we'll take a look at why it's crashed and where I see them heading in the future. Alright, now if you've never heard of SoFi before, they were founded not too long ago, back in 2011, before they recently IPO'd in 2020. Now this is a fintech company that is based in the San Francisco area, like so many other tech startups. And what they do is they're basically a financial technology services company that provides an all-in-one type of financial finance platform that helps their users borrow, refinance, save, spend, and even invest their money. So where you can do everything that has to do with money, you can do all of that within the platform. Usually the mobile platform is where you're going to be doing all of that. A lot of this comes in the form of student loans, which is the largest part of their business at around a fifth of their revenue. And it's really how they started out and gained popularity was by offering borrowers different options for refinancing their student loans, which we'll talk more about in just a second because you guys know like how, controversial and political student loans have become. We'll talk about it. But on top of that, they also offer different types of loans, personal loans. They offer, debt consolidation, home loans, mortgages, credit cards, all kinds of banking and payment services. And like I said, they even offer investing, which is very similar to something like Robinhood. It a lot of times gets compared to Robinhood, but because of their diversity, a lot of times they also get compared to Square, and that's probably more of a better comparison. But going back to the Robinhood comparison for just a second, SoFi offers stocks, ETFs, IPOs, automated investing, and several different cryptocurrencies. They even offer retirement accounts like traditional Roth and IRAs, which is something that not even Robinhood offers yet, at least not at the time of this recording. Really, the only drawback that I could find when comparing them to something like Robinhood is that apparently they don't offer options trading, and their crypto trading charges a 1.25% fee unless you sign up for their direct deposit. Other than that, though, it looks like a pretty decent alternative to Robinhood if you're looking for something different. Although some reviews online do give Robinhood a better rating for the platform and the ease of use, which is something that Robinhood has always done a fantastic job of. But either way, SoFi looks surprisingly good, and they even offer fractional shares too, which is something that even some of the biggest names like E-Trade don't even give access to. Anyway, so far it looks like SoFi's diverse strategy of different product offerings is working well for them, as they grew users in the last 4 quarters by 110%, 113%, 96%, and 87% respectively, having now reached about 3.5 million users. Contrast that with Robinhood though, who despite offering a smaller amount of services, still managed to accumulate almost 23 million funded accounts and over 17 million monthly active users. For whatever reason, Robinhood just seems to have a stronger brand and is currently more popular among active traders and investors. The other concern I have with SoFi though is that while their growth is certainly impressive, the highest growth rates have come during the 2020 and 2021 global health issue, where many people spent more time on their phones, had access to stimulus checks, and were likely tempted to invest, especially in the stock market and crypto, because of the 2020 market crash and the huge rally that followed, along with all those wild swings in crypto. Now, granted, Robinhood and other competitors have experienced similar growth spurts because of the same reasons, but my question is, will that growth continue, or is it destined to slow down like so many others have also been experiencing as well. I mean, keep in mind that their financial services segment, which includes that investing and also banking and credit cards and so on, it only makes up around 6% of their entire sales. So, if anything, it needs growth to ramp up. It doesn't need it to slow down. That would be a bad thing. Now, almost 20% is made up of their technology platform, which is a very impressive segment that provides application programming services to other companies so that they can build out their own digital banking products. And that includes more efficient issuance of credit cards, processing payments, and a number of other things. It's definitely a very high growth tech segment with a ton of future potential. And we'll talk more about it a little bit later. But the vast majority of SoFi's business, however, still remains in lending at a whopping 75% of their sales. And the majority of that segment is in student loans, which is a very speculative market to be in right now, considering how political student loans have become. The debate on whether the $1.6 trillion of student debt should be wiped clean is one that has been raging on for years now, but so far, the only thing politicians have really done is extend the pause on student loan payments that was put in place at the start of the pandemic, which allowed borrowers to skip payments without any interest or added penalties. Well, recently, Morgan Stanley downgraded SoFi stock from overweight down to an equal weight rating and dramatically slashed their price target from $18 a share all the way down to just $10 a share because they expect President Biden to once again extend the pause that was supposed to expire soon in May. Which, by the way, the Federal Bank of New York recently said that they would expect a meaningful rise in student loan delinquencies if the pause is lifted. But that's not even a problem that SoFi can address because people aren't even being forced to repay the loans in the first place, and as a result, SoFi management told investors that because of the pause and its extension earlier this year for the first quarter, their revenue will come in at least $25 million lower than expected, while their profit from adjusted EBITDA will also be at least $15 million lower as well. That's a huge deal because the longer that these type of policies go on for federal student debt, the more pain SoFi is going to have to take on the bottom line. For context, let's go back to that revenue chart. If we subtract the cost of revenue for each of their segments to get down to the gross profit, we can see that virtually all their profits come from the lending segment, while only a small amount is coming from their technology platform, and then financial services is actually losing them over $100 million, at least for the 2021 fiscal year. And none of that is even considering the idea that student loans could just be wiped out completely at some point. This is an argument that is especially very prominent among the left of the political aisle. You had Democrats like President Biden when he was going for election. He promised to cancel up to $10,000 of federal student debt immediately upon getting elected. Still hasn't done that. He's been doing pauses, but that was something that he heavily talked about. You also had Senator Elizabeth Warren. She's been calling for cancellation of up to $50,000. And then you even have Senator Bernie Sanders. He's been calling for just outright canceling all federal student debt completely. And there's been many other politicians that have talked about this, and there's even some Republicans that have talked about similar things as well. Again, all of this is really just speculation, but what we know for sure is that this would not be a good thing for SoFi's business. And because of that, among other reasons, the stock has been getting destroyed. Now, granted, the stock is also crashing because of the weaker macroeconomy, where investors are choosing safer, profitable companies over unprofitable spec stocks. But because of that, along with the uncertainty of student debt, SoFi stock has now crashed by over 65% from its highs after going through one of the wildest kind of roller coaster rides in the entire market. However, I don't want to sound overly negative on SoFi because the way that management has been able to evolve and innovate the business beyond just relying on student loans has been super impressive. And I think it's something that is only going to ramp up over time and into the future, which we already see happening with the other parts of their business right now and how they're growing at incredible rates. In fact, if you look at their sales growth, lending grew last year by still a super impressive 42%, even with the student debt pause, which is a very good sign. But the areas that are really skyrocketing are the technology platform at over 100%, and then the financial services with a massive close to 400%. And so those are the two areas where I really think SoFi should be focusing a lot of their investments for future growth, especially over the long term. And thankfully, that's exactly what management is doing. When you look at the technology platform, this really started to ramp up a couple years ago when they acquired Galileo, which is a banking as a service company that integrated their APIs into SoFi's own mobile platform. And that helped attract both commercial clients that benefit from Galileo's more efficient platform, as well as consumer clients from SoFi that also benefit from the more robust platform that SoFi now offers, leading to that giant growth that I showed you in the segment. Management has often explained this to investors as something similar to what Amazon does with their AWS cloud platform, because it facilitates and enhances the consumer experience on Amazon with robust new technologies while also attracting commercial clients just for AWS alone. And speaking of the cloud, SoFi recently announced another really important billion-dollar acquisition, this time for Technisys, who makes cloud-based processing technology for fintech companies, various banks and financial institutions, and more, many of which are still using legacy processing systems that a lot of them were developed like in the 1900s, and they use different ones for different products like deposits or lending. But Technisys, they come in and they streamline all of these different services and different things into one core system that is more efficient, and thus it helps these finance companies evolve and helps them innovate a lot faster. So it's a very good selling point when they're trying to attract new clients. It's also pretty similar to what Galileo does, so the two really complement each other very well, and they're making SoFi one of the most technologically advanced fintech companies in the market, which also is going to lead to even more growth and better margins. When talking about this latest acquisition, management said that the Technisys deal will lead to as much as $800 million in added revenue, $85 million in cost synergies, and high incremental margins through 2025. This is a big deal because you're talking about close to as much in sales as they even paid for the acquisition, which is also about the same as they even generate as an entire company themselves, only doing less than $1 billion over the past year. But with these innovative moves, SoFi has been able to put up super impressive growth rates of 74% last year, 55% expected this year, and still another 41% expected next year as well. Meanwhile, the financial services market is not only a gigantic one with an estimated value of well above $20 trillion worldwide, but it's an aging market that is perfectly ripe for disruption through innovation. Probably one of the reasons why you've seen, things like cryptocurrencies really take off in popularity and stuff like that. But this is where fintech companies and the fintech market really comes in for all of this disruption, which when looking at the fintech market, obviously it's going to be way smaller by comparison, but it's still expected to be worth $300 billion by 2025. Again, SoFi only did less than $1 billion in sales last year. So this is, like 300 times larger, again, by 2025. But maybe even more importantly, not only is that a giant market, but it's growing at around 20% a year. Do you have any idea how high that growth is for a market that is worth 300 billion? Like, this is incredible growth. What my point is that this is a giant pool of opportunity. SoFi will probably never reach the limits of the opportunity here. You could say that it's kind of limitless in terms of opportunity. SoFi just really needs to execute and take advantage of all the opportunity that they have here. But the biggest kind of issue with SoFi, a lot of people would say, is profits, because all this all this time we've been talking about sales, and that doesn't translate over to profits. That's something that's been a concern for SoFi and the efficiency of their business. They lose hundreds of millions of dollars every year on the bottom line. And even if we were to look at operating cash flow, which is something that I like to do with smaller companies because it's just a raw cash that is generated from running their normal core business activities and how profitable those activities are. Well, SoFi actually lost more money last year than they even brought in sales, which is, never really a good sign. Still, there are ways that they can improve, and it does take time. So let's look at the valuation. Is the stock at least cheap? Well, not really. I mean, even after the recent crash, their price to sales ratio is above 7, which is not considered very good. Now, granted, that can come down very quickly when you've got high revenue growth. So it's not crazy high, but it is something that's going to take several years until it gets down to a more, palatable level. Meanwhile, major competitors like Square and Robinhood both of them trade significantly cheaper at around a 4 and less than a 3 PS ratio, respectively. Now, the counter argument that I would make to that, though, is that they don't have as high growth as SoFi, and Robinhood is also less diversified. So you could argue whether it's a good valuation or not. But for what it's worth, even with the high valuation, SoFi's current stock price of $9.37 is not only less than half of the highest price targets from analysts, it's not only significantly lower than the average price target, but it's even lower than the absolute lowest price target as well. I'm not saying that that makes it a buy. Analysts are notorious for being way off on price targets, and they frequently release updates just to adjust their targets whenever a stock goes either way higher or way lower than what they predicted. But it does still add, maybe a little bit of security, just kind of knowing that analysts are expecting better things for the stock. But at the end of the day, we could probably argue back and forth on whether SoFi stock is a buy right now, just because there's so many different reasons that can fuel both a bearish argument as well as a bullish one. But I just think it really comes down to understanding the risk reward ratio with a stock like this and then determining for yourself whether that's something you're even looking for. Are you looking for a beaten down high growth stock with tremendous long-term potential, but one that is also highly speculative, unprofitable, and that is dealing in a very difficult macro environment where you've not only got student loans that are paused and may even get canceled at some point in the future? It is a possibility, and that would significantly impact their business. At least around a fifth of it is from student loans. So that's a concern. And then you also just have a very weak macroeconomic environment just in general, where an economic crash is possible with all the crazy policies and different things that we've been doing. We've been experimenting a lot with the economy. So there's a lot of different ways that this could play out. And because of that, I think the stock market will continue to make this a very volatile stock just because of the environment that we're in. I think you're going to see huge swings both to the upside and to the downside. Look, some people actually want a stock like this because a beaten down spec stock can skyrocket off of good news. Say something happens with student loans, say they don't get canceled and people have to start repaying them. I could see the stock shooting up by a large amount just based off of that alone. Or if the macro economy just starts to gradually improve, that would be a perfect environment for a stock like this to really shoot up. However, the complete opposite could happen, and that would be a horrible environment for a stock like this, and it could continue to struggle very badly. So it just kind of depends on what you're looking for. I myself invest less than 10% of my portfolio in spec stocks because of all the potential that they have. Spec stocks can really make you some nice profits, and at less than 10% of my portfolio, I really limit the risk there because I'm not overly exposed to them. So that's the strategy that I utilize. And if I was looking for more spec stocks, I think I would probably pick up some SoFi stock because it is one of the most attractive in that category of high risk, but also maybe high reward spec stocks for the long term. However, just for me personally, I've been buying way too many spec stocks lately. Like over the past year, I purchased way too many of them. You guys know this if you've been watching my videos. And a lot of them have actually not performed very well because the economy itself has been doing pretty bad, which is not good for spec stocks. Spec stocks really struggle when the economy is shaky because investors don't want that added risk. So they'll turn to safer investments, more proven, more well-established, larger companies with very strong brands and strong moats and strong profits, and also dividend stocks and things like that. So they'll gravitate more towards those. And then the highly valued spec stocks that are unprofitable, those tend to get hammered the worst, which is something that we've been seeing already. So it just kind of depends on what you're looking for. I myself am trying to lower a little bit of my exposure to spec stocks because I've already been buying too many of them. But if you're someone who is looking to pick one up and add that to your portfolio, then this may be something to look into. But if you're someone that is more pessimistic about the economy and you think that things are not looking good for these type of stocks and you're just not looking to add more risk to your portfolio because you're already worried about it, then you probably shouldn't be gambling on a stock like this. That's just my opinion though. For me, I'm going to stay on the sidelines for now because I am trying to lower some of the risk in my portfolio. However, if the stock keeps crashing like it is, damn, is it attractive, especially from a long-term perspective, which I can usually stomach the volatility because I'm always thinking very long-term. But I'm going to hold off for now unless it keeps crashing. At some point, it might just get way too attractive for me to ignore anymore. Again, I think it's one of the most attractive spec stocks out there in the market, but it's not the right time for me to be picking up more of those. So I'm going to stay on the sidelines for now. But that's just my opinion. I'd love to hear what you guys have to say down below. Again, I get a lot of comments about SoFi stock, so I think most of you are probably bullish on it. But are there any bears out there? Let me know what your bearish arguments would be. And if you do own the stock and you're bullish, let me know what your bullish arguments would be. I'd love to hear those thoughts. I'll try to respond to as many comments as I can. Good luck with you no matter what you're doing out in the market. And I really appreciate all the support and for you stopping by. Thanks again. Hit the like button if you did enjoy the video. It means a lot to me. I'll catch you in the next one. Take care, everyone. Bye-bye.